We're running through all the macro forces behind gold, the stock markets, and miners with Tavi Costa. He is a portfolio manager at Crescat Capital. Welcome back, Tavi.
David, thanks for having me.
You're a great macroeconomist. I was looking forward to having you back on the show. Last time we had you back was late last year, so you were more than overdue for a return. Lots has happened in the markets overall, but the gold market has suffered significantly this year, as you know. We'll be talking about that. So let's start with gold. My theory is that there's a lot of competition now with cryptocurrencies, the rise of NFTs. A lot of people are taking money out of that. This is a fun little story I was reading. Somebody just paid $1.3 million for a picture of a rock. It was Justin Sun. He is an acclaimed, famous crypto investor. He spent $1.3 million on an NFT of exactly that picture. So I don't know. I don't know, Tavi. If you had $1 million, would you buy a picture of a rock or the actual rock itself? Gold, silver, whatever the rock may be.
I might just buy silver instead.
So, I mean, this is a tongue-in-cheek article, of course, but it does strike the point that a lot of money is being used in other things besides traditional investment vehicles. How much of that would you say is an influence on the gold price action that we've seen since last year's highs?
Oh, there's definitely seen some of that. I think that the crypto markets have certainly stole a lot of the shine from gold. I would say as well, we've had especially some macro forces recently with the Federal Reserve trying to taper here, especially with the recent improvement in some of the lagging information that we had recently with the labor markets, really gave the Fed the green light to do that. The question is, how sustainable can they really taper? Can they even remove some of the liquidity in the markets today, given the dependency really on a lot of the treasury markets in regards to where yields are and how suppressed they have to be given the levels of debt. So I'm very focused on that. I think that the crypto market, there's so much money slushing around, to be quite honest, and there's a lot of very high valuation types of companies and high multiples and a lot of risky assets. And I'm being very careful with what we're doing in regards to where to put our money on. And so we've been looking for a lot of the really tangible assets is where we like to be invested in an environment where it's so hard to find anything that yields more than inflation today.
Okay, so let's move on to gold. First and foremost, I want to show this chart from a slide deck that you gave me earlier. Now, this is a very interesting chart. Gold and real rates, the two variables have historically held a very close negative correlation to each other. Recently, of course, you're seeing a divergence. In this chart, you're seeing gold in the white line, and the red line represents the 5-year real yield. So inverted, of course. What can you make of this divergence, and what does this mean? Which side of this chart, the red line or the white line, is likely to converge first? Or maybe there's no convergence. Maybe they will be diverging forever. What do you think?
No, I think it's a buying opportunity for gold, especially when you look at that chart. Obviously, that's just one factor. There's a lot of other factors that you should be factoring in. One of them, in my opinion, is really if you believe there's going to be further monetary and fiscal disorder going forward, I think you want to be owning gold and you want to own tangible assets as a whole. I think that's definitely the case right now. There's really 3 pillars of inflation really running at full cylinders today, in my opinion. A real transfer of wealth from the government to the people, which I think is going to create a demand pull that we may see, especially giving money to the bottom 50% of the population. The second pillar has a lot to do with the cost push side of inflation, which one of it has to do with the parts of the logistics and supply disruptions we had recently. But the other part of that pillar that is very important is the structural changes that we're seeing in regards to wages and salaries, which I think has been a major reason for why we haven't seen inflation in the last 30 years, where wages and salaries growth have been in a declining trend. I think that's about to change. We're already seeing some of those changes happening under the surface, which I think it's very important. It's going to squeeze some margins of companies, but also really feed on this inflationary thesis. The third pillar that is very important has to do with the monetary dilution and really the monetary debasement that we're seeing across almost any fiat currency. But the need for the Federal Reserve to suppress rates rather than everyone really focusing on stability of inflation and maximum employment, all the Federal Reserve's mandate really is is to suppress rates and allow the government to borrow more money at cheaper levels. And the fourth one has to do with China, which is the deglobalization patterns we're seeing. They're going to take a while to really play out, but I think that's certainly inflationary as the whole world starts to leave China as being their manufacturing plant for so many years. The optionality behind gold is just so attractive. Even in a deflationary world, gold can perform very well, i.e. look at in Japan, where money velocity has been falling, deflation has been the case, and gold in Japanese yen terms has been rising. So a lot of reasons to own gold today. And you want to own gold at times when it's hard to find, or tangible assets as a whole, when it's difficult to find yield. And so this is the case today. I think that's the best capital allocation to really spread around a lot of tangible assets in your portfolio.
I just want to, we'll come back to inflation in just a bit. I want to touch on this chart one more time. And I just want to ask you very briefly why you think this divergence happened in the first place.
Well, I think it has to do with what gold was pricing into what the Federal Reserve was going to do. I think it has to do with the Federal Reserve now signaling the taper. I think that was one major reason. Inflation expectation has kept up pretty high, actually, relative to nominal rates. Nominal rates fell, and that created this opportunity. In fact, the Federal Reserve actually increased its purchases of treasuries, which is so odd to be talking about tapering at the same time increasing its purchases to levels we really haven't seen in the last few months. And so that increase certainly drove the higher demand for treasuries, drove nominal yields lower. Actually, you've seen the inflation expectations staying up pretty high. And so, but at the same time, with the Fed really signaling the other way around, saying, well, we're going to be tapering here, the gold market really would say that that's the reason for the sell-off. I think it's an opportunity. I like this. The risk reward is as interesting as it gets.
All right, let's talk macro now. Tavi, I want to focus on three pillars of macro, the first being inflation, and the second being the labor market, and third, finally, monetary policy. So the first one, inflation, you have this interesting chart here. The first one showing the three inflationary waves of the 70s. In the second chart, right before that, you wrote that, note that during each of these inflationary spikes in the past, CPI stayed above 5% year-on-year rate every month for 2 years. To our friends, the deflationistas, if this is an accurate roadmap to follow, buckle up, the rise in consumer prices is just getting started. So I'm assuming you think that inflation is going to continue rising. 5.4% is not the peak for you?
Well, first of all, this research started because I wanted to compare the 70s and the 40s as some of the 2 decades that people have been using in order to compare with today. As an analog, the 70s would be, which I don't think there was a lot of financial repression in the 70s. We saw monetary policy really following along what was happening with inflation. So when inflation was rising, the Federal Reserve was capable of really raising rates and doing things different than today, given the levels of debt. If the Federal Reserve raised rates to 2%, it would shock the market. It couldn't even be able to do that. And so that is one major difference of the 70s. But the inflationary forces in the 70s really build on themselves over time. So you see higher lows and higher highs in those trends of the inflation of CPI. Now, the other thing is in the 40s, where a lot of people like to use the 40s as a transitory example. What's funny about that is that it really did take another 2 years until CPI declined below 5%. If we're in a scenario like that, we're just getting started today. I think a month ago was the when we crossed the 5% line. So we are just getting started if that is your scenario. And I'm not sure the equity markets I priced in for such a high inflationary forces going forward too. And so I'm a little worried. But the two scenarios, what is interesting is that we are in a much more extreme levels. In the 40s, for instance, the tax rate at much higher levels than it is today. For instance, the higher tax bracket was at about 90+%. Today, we're at about 37%. So it's significantly lower. Aggressiveness, even in the multiples in the markets, and multiples back in the 70s and 40s was not even close to the multiples we see in equity markets today. And so there is a real sense of limitation from the Federal Reserve to what can they do if inflation does get out of control. And in my opinion, this is the big risk, is that inflation will run a little bit higher than what they're expecting. And what concerns me is that reading about the markets back in the 40s and in the 70s is that there was a sense of acknowledgement by policymakers that inflation was getting out of hand. They knew that fiscal stimulus could essentially create inflationary forces in the next months or years if that was imposed. And this time around, we're talking about increasing fiscal stimulus in order to fix the inflationary problems. It's a clear answer to the problem where I don't think policymakers have really either don't remember what the issues are with inflation. I think most of the population in the U.S. don't remember what that is. Me coming from Brazil know exactly what that is, and some folks from the 70s know very well. But it's different from the 70s. It certainly is much more repressive, and there's a lot more limitation from the Federal Reserve on what they could do. And that's why I think we're going to trigger inflation, long-term inflationary problems in the following years.
Okay, well, can you just boil down the most important drivers for gold investors, that is, and just strip away some of the other variables that are not important. People talk about inflation being the most important driver, but actually, I'm thinking about the past 3 cycles in which we had gold rallies rather. Last year, when gold rallied, we didn't have inflation pick up right away, and so CPI didn't pick up until earlier this year. Before that, 2011, there wasn't really high inflation. It was right after the financial crisis. So we can't really attribute the gold rally of 2011 to inflation. And then in the early 80s and late 70s, yes, we had very high inflation. But then, as you know, gold fell after 1981 when inflation remained high. So that was a little bit confusing in terms of the indicators as well. Because can you really definitively say that gold and inflation are linked? In other words, gold needs inflation to rally? Can you make that statement?
I wouldn't make that statement. I do think gold does perform very well in both scenarios, inflation and deflation. And unfortunately, like a lot of markets, it's very difficult to figure out what is one factor that actually moves that. I think there's a combination of factors that makes me so confident that we're in a secular bull market for gold and silver. And we've been in a consolidation period so far. The real rates is certainly one very, very strong one, which we saw in the 40s, we saw in the 1910s, and we saw in the 70s. All those negative rates were actually very, very negative, in fact. And so there is, I think, the second part is just the lack of alternatives of investments as a whole, where capital allocators are forced to look for, especially capital protection. When you start seeing, really in the 70s, we saw this lack of discipline really started a trend. And now we're seeing quite the opposite. I think there's a sense of an acknowledgement by investors that there is a problem from monetary disorder issue that we've seen throughout, especially since the pandemic started. And so the crypto market has been really built on that, and especially Bitcoin and some other cryptocurrencies. And so I think that sense from investors is going to force central banks to really improve in international reserves as a whole. So we're going to see central banks buying more gold. They're going to be forced to improve the quality of what backs their own currencies. And so I think that's about to happen in the following years. It's going to take some time, but that's going to be an important driver of gold prices as part of the demand. The other part of it is supply. We haven't even talked about supply, but we haven't seen any new gold discoveries in the last 30 years. And so I think there's definitely a geological a problem or a challenge to find gold. On top of it, the capital conservatism that we're seeing by the miners to really spend money to look for gold and silver, and miners in the base metals too. And so I think that all kind of ties up together with this view that I think we are in a secular bull market for gold and silver. We're in a consolidation period since August. We saw a large move in gold in August of 2018. It was up about 75% all the way to August 2020. And then we've seen so far kind of a sideways move. And that is perfectly normal. Gold does not move very fast for a long period of time. And so we're seeing a consolidation period. And I think it's time. Gold is even cheap relative to commodities today. And so I think it's a good time to be looking at gold as an allocation.
Okay, so back to macro now. We've touched on inflation. We talked about monetary policy. The other pillar I want to discuss with you is labor, the labor market. You have a few interesting charts. The first one being the percentage of the population that is quitting the labor force as a year-on-year change. So you're writing the disclaimer here. Government policies seem to be discouraging folks from returning to the labor market. In fact, in the chart shown below, people continue to leave the labor force rather, like never before. I'm going to add to that actually, and if you take a look at the St. Louis Fed quits rate, this shows the number of people as a percentage of the labor force quitting, and it's been record highs. So I wonder if this is going to mean revert back down once government policies accommodating government policies? In other words, the stimulus checks. Once the stimulus checks end, do you anticipate both of these lines to normalize back to historic means?
Just like inflation, there's transitory problems and there is really more long-term standing issues here. And the long-term standing issues, if you're in the mining position, for instance, to look for a very highly skilled labor, it's very difficult. There aren't a lot of folks that are in the geology world and working in that environment at all. And so there are a lot of industries that are having a difficult time finding skilled labor as a whole. This has nothing to do with the pandemic. Now, going back to the pandemic, certainly that exacerbates the problem that we're seeing when it comes to very similar to what we saw during the Spanish flu. During the Spanish flu, we started with the logistics problems, the supply issues that are normal during, I guess, we only had one in the last 100 years or so, which was the Spanish flu. But what we saw back then was that the price of goods and services began to rise, raw materials began to really stay rare. And so that created a cost of living began to rise too. And folks began to really demand higher wages and salaries. 1 out of 5 workers in the labor force in the US was engaged really in a protest, in the labor protest. And so this is I'm not necessarily saying we're going to see to the degree that we saw back then, but I think we're starting to see some of that. As cost of living is rising in the US right now and some other parts of the world, that should create demand for those folks to start asking for higher wages and salaries. We are already seeing that in Wall Street firms. We're seeing that in Chipotle and other firms and restaurants and so forth. And this issue of the lack of folks in the labor market actually leaving the labor market is really just magnifying those forces. And so I think we're about due for, even minimum wages. We haven't seen an increase in minimum wages in a real long time. This administration is clearly very focused on the peak, what I call peak inequality of narrowing the wealth spread between the lower classes and the higher classes. Like it or not like it, that's not my point. My point is, I really think that's what's going to be driving the policies going forward as well, along with green revolution and an infrastructure revamp, and also a fiscal arms race with China. All those things are going to drive demand going forward, but also I think wages and salaries we're going to see a structural change in that.
That's a good point you made about the minimum wage, because I've heard economists theorize that the Biden administration actually wants the labor market to be very tight right now, because that is a very indirect way of raising minimum wages to $15 an hour. It's more effective, they argue, than actually having to pass it through Congress. But actually, if you're looking at the Atlanta wage growth tracker, for example, it hasn't significantly picked up. So whether or not that theory is indeed true, it hasn't really been effective in raising wages. Do you find that curious, how the quit rate is at record highs, the people leaving the labor force is spiking, yet so far, according to government data, wages have not really spiked up, at least to the same proportion?
Yeah, I think just like any other macro factor, we are seeing signs of that in different parts of the market. So I calculate, just take the personal income side of wages and salaries, or take the wages and salaries part of the personal income and divide it by the total amount of people employed, or the labor force, actually including the other folks, or I should say just employed folks. And what you find there is that the rate has been increasing over time as well on a year-over-year basis, and that's breaking also a secular decline on that line. And so I think that is one important point. There was a Richmond average wage survey that came out yesterday or 2 days ago that was quite interesting. It also hit a record level. So there are some signs of that starting to appear, in my opinion, and we're going to start seeing that more in the earnings. Really, where I think there's going to be changing a little bit of leadership in the markets, where back in 10 years ago, what we saw really working was the top line growth. And now I think we're going to see more bottom line prioritization, where I think folks are going to be looking at margins because of the squeeze in margins through the labor markets.
So you're expecting earnings to drop. That's the bottom line from all this. You're expecting earnings to be lower or more pressured because of higher wages and the tighter labor market?
I think some of that's going to be passed on to the consumer, unfortunately. But I do expect some squeeze in a lot of companies. What we're looking at is a basket of companies that have very tight margins and not a lot of selling power And so I think that's going to be the key going forward. Free cash flow to employee is one of the factors. There's quite a lot of factors you can put on to look for a selective amount of companies that may suffer in an environment like I just said, with wages and salaries increasing.
Before we move on to stocks and miners, I just want to end this segment on a bigger idea here. What if the government doesn't end the stimulus checks? What if this is just a prelude to some sort of UBI, universal basic income, and we don't see that spike in the quit rate drop? We don't see that return to the labor force. Is that a possibility, do you think?
Oh, I think you have to have the humiliation to believe that anything could happen. I don't think it's not my base case scenario, but I think we're gonna go there at some point. I think that's the whole. I think that's one of the things that may play out in the future. Maybe not just yet, but I think that's yeah.
That's a scary thought because I've talked to some business owners who they've had to shut down not because they don't have demand, but because they can't find labor. So if people don't report back to work, it's going to be we're not going to see maybe the kind of growth that maybe some economists would be projecting, right?
Yeah, well, the higher those folks are going to come back as long as you all you got to do is increase your wages and salaries 20% and see if they come back. If they don't, I'm not saying I just threw a number. I don't know what the number is going to be, but I do think that's essentially what's going to happen. It's we've seen that over and over in other parts of the world, not just in the US. And usually there is a real sense of transfer of wealth from the government to the people. That is happening in a huge way. And the more interesting side of that is the focus on the bottom 50% side. And as we know, especially if you study emerging markets, is that those policies tend to be very inflationary. Those folks do spend money. They're unfortunately, less financially savvy, and they tend to spend more money. And so we may see, that actually happen. And I think, food stamps is a great example of that. We just saw a 27% increase in food stamps recently. Obviously, that's not going to be the thing that is going to lead to a massive demand, but that's not transitory. That's staying. And so those are important changes already happening in the system.
Okay.
I'll give you another example real quick. Cancellation of debt. What about student loans? What if you do have that? That's another form of wealth transfer. And some folks are very, very serious about pursuing those policies. I think they're very realistic in regards to if they will happen or not. I think they might happen.